A report by North Court shows that petrol subsidy removal, naira float, among other policy reforms Nigeria is undertaking will spike the cost of construction and property maintenance in the short term, while diaspora investment in the Nigerian real estate market is also expected to slow as asset repricing also begins. Ayo Ibaru, Chief Operating Officer and Director of Real Estate Research at North Court, joins me now to unpack the outlook across the value chain. Thank you so much for joining us on the show today. Let's really start off with some of the key pointers you're making here. The top agenda we've seen pan out reforms under this administration, petrol subsidy removal, and then we're also looking at the naira float as well. This has far-reaching consequences across board. Now, for the real estate sector, we are looking at mortgage prices likely to rise. We're expecting, you're smiling there, we're expecting other changes to come into bear, a shift towards more intense land usage so that we just see some recuperation of some of the impact and spike of construction and other property maintenance costs that we might likely see here. Unpack the details of what this report means for us in the short term. How bad will things get?
Thank you very much for having me. So to analyze what's going on at the moment, we used Kubler-Ross's grief cycle. It came out in 1969, and we thought it's apt, seeing that it starts with denial, then anger, then depression, then bargaining, and then acceptance. And Nigerians, by and large, are at different phases of this cycle. We also looked at Leontief's input-output model. That came out in about 1930 to pretty much analyze how changing in pricing of fuel, of course, in this case, seeing that the subsidy has led, or its removal has led to increase in prices, will affect other areas in the economy. Now, in the case of Malaysia, we looked at 62 various sub-aspects of the economy. But in Nigeria here, we can expect, as you may have already seen, and of course you said, increase in the cost of construction. That, of course, will dovetail into increase of property maintenance costs. So if you go on the average WhatsApp group of every gated estate, there's always some argument, diesel fee, and so on and so forth. Costs, and so that has further discouraged construction activity because labor costs have gone up, leasing equipment has also gone up. And quite a number of costs have gone up, so much so that a few developers will struggle to complete their projects, while some will have to pretty much just push it across the finish line. So that's really what we're seeing in the short term.
Let's talk about the fate of some young investors within the real estate sector, like myself, who are making instrumental payments on projects now. How do you see things panning out in terms of the delivery of this project, and whether or not these agreements might likely shift based on the initial agreements or terms and conditions which were signed based on the pricing developments as at then when the project started, say, a year ago or early this year?
I mean, to the credit of the developer and the investor market participants, they did push through the installmental payment system, which pretty much means that upon inception of a project, you have the option of paying over as much as 36 months prior to stepping into the completed structure. So what you would find is the average developer would come up with a project well conceptualized and would pretty much give options of payment, and based on that financial model, they would hit the ground running, as we would say, and they would execute those projects over the stated period of months. Now, what these changes, as we have seen, has done is it has rendered those models completely worthless. And what do I mean? Let's take, for example, a project that said, okay, we would deliver a house to you at 20 million naira, let's just say, and you pay over a period of 36 months. Now, you cannot complete that same house with anything less than 35 million, and that cost is progressive.
That cost could have actually given somebody about a two-bedroom, say, a year, 2 years ago.
And what developers do is they take the risk using their own capital, and then, of course, funding raise, and then they start the projects. But now, quite a number of developers are in a hole. And to get out of that hole, they would need to shell out multiple sums when compared with what was in the original model. So, more to your point, what you will find is there will be a delay in completion. Some developers have pretty much decided to pause all construction activity. If you notice, a bit of the marketing on housing and projects has died relatively down, especially in our key cities of Lagos and Abuja, and of course Port Harcourt. So that's what we see now. Now they will go back to their first love, as we would call it, which is selling land, which really remains resilient as an asset class regardless of what's going on in the economy.
And mid-term, we're also expecting some exit of low-risk developers and investors as well. And then in the long term, when things definitely balance out, you're expecting to see increased investment flows in the industrial and infrastructural real estate space. How much of a rebound do you think we'll have after we go through these turbulent times?
Interestingly, one of Nigeria's leading economists has suggested that by Q1, Q2 2024, we will see some recovery and some recovery in terms of the general performance of Nigeria's economy. And standard theory suggests that the real estate market takes its cue from what happens in the economy. So we can expect maybe 2 or 3 quarters after that. So generally, all things being equal, the economy has to recover first, because that's where the demand comes from, which in turn pushes supply, which in turn
and
pushes
in the case
demand.
of new reforms coming, we're still in the early days of the second half of the year?
I mean, this is really where the need to base projects on the kind of things we do. And I'm not putting any plugs here.
Okay.
No, really, because this is where you have to now navigate things properly, which is why in the report we also put one of the ways. Mixed-use development will be a strong way going forward. Okay. Now, that train has been on for a couple of years, but now it will have more people wisely latch on, because you can't build a singular development and it's just one use. It's 90% office, 90% retail, 90% residential. That doesn't cut it anymore, and it is unlikely to do so as we head into the future.